Hello, everyone, and welcome. I'm gonna just making sure we have everyone in the room. Yes, I see everyone coming in. And Steve, you can hear me?
Yeah.
Awesome. Well, hello and welcome, everybody. Thank you for taking the time to be here today. I am Divya Kakkad. I'm the head of platform at Graham & Walker. And if this is the first time you are joining us, Graham & Walker is a venture firm on a mission to reshape the NASDAQ by supporting and investing in tech companies founded by women. Part of that support is programming, which includes our accelerator and sessions like this. And today we're here joined by Steve Kuyan, who's the co-founder and co-CEO of Culina Health. Culina Health is creating the category of consumer clinical nutrition, democratizing access to insurance reimbursed nutrition care to the 300 million people in the US that have a chronic condition rooted in metabolic disorder. In full disclosure, Culina is a Graham & Walker portfolio company. I've worked with Steve, known him through this, the time that you all have been involved with Graham & Walker. And let me tell you, like, he is a wealth of information. He comes, the background, I'll get into a little bit of that. Like, I'm really excited about this conversation, not only because you're, of course, a fantastic entrepreneur, a serial entrepreneur, but also prior to Culina Health, Steve was the director of entrepreneurship at NYU Tandon School of Engineering, where he co-founded the NYU Tandon Future Labs and the NYU Center for Responsible AI. Over the past 12 years that Steve led that program, the Future Labs graduated more than 250 companies, 40 as acquisitions, totaling more than $500 million for a combined portfolio valuation of graduates exceeding $3 billion. Welcome, Steve. I can't think of a better person to take us through today's conversation. And thank you for just taking the time and your commitment to founders. I just gratitude, just lots and lots of gratitude.
Thank you. No, it is my pleasure. I thank you for organizing this and the Graham & Walker team for doing this. As you mentioned, Divya, like this, I come from a background of doing a lot of community events, so I know how important these sorts of events are. So thank you for having me.
Absolutely. For folks in this room, I'm going to hand it off to Steve, who's going to take us through a presentation. And, while that's happening, feel free to drop your questions into the chat, and either he can address them as he goes along, or if that doesn't happen, I will make sure that towards the end of the conversation we will have some time, and I can sort of bring that in then, and we can have it. We can do a Q&A at the end. So either works, Steve. I don't want to, as you're going along, if you're able to address questions, great. If not, we'll make sure we, do that in the end. So with that, over to you, Steve.
Awesome. Thank you so much. Let me pull up the slides now that I can see it. So maybe I can start off by saying that no one's going to be able to give you perfect advice, especially myself. And one of my slides that you'll see today actually has the specific qualifier not to take too much advice during a downturn, in part because everyone's operating with imperfect information. But my hope is that we can turn this into a conversation. To Divya's point, if you have any questions, please ask. I don't position myself to know all the answers. I'm learning about it myself now as a startup co-founder. But what I do know, as Divya mentioned, is I was lucky enough to have started at the Future Labs during the last recession in 2009. And now starting a company during whatever economic condition you want to call the current climate. At least there's some things that I hope to share with all of you to at least get you thinking in the right perspective. So cover a couple of things today. I actually have a really interesting case study. I used to teach entrepreneurship, so sorry if I pontificate, but I have a really interesting way to reframe your thinking around the way that we at Culina are thinking about how we position ourselves, using Southwest Airlines as an example that we can get into, but we'll see how we get there. As Divya mentioned, my background has been sort of startup entrepreneurship ecosystem for a long time. And I was lucky enough to have met my co-founder, Vanessa, and left the amazing world at NYU Future Labs that was so super exciting to work alongside entrepreneurs. So hopefully I can pull from some of those examples today. A really interesting starting point, and actually maybe if I can ask if you guys can use like the hand sharing or hand raising feature, how many people here are currently founding a company or thinking about it, like, or maybe how many people have a company right now? So a handful of them. Oh, hey, Ellie, how are you? Okay, so a pretty good percentage of people here have already started their company. What you probably know, and I don't have to tell you, is it's both never been easier and never been harder to start a company, right? The accessibility to opportunities, technologies, and the like has never been more prevalent. But and even from a talent perspective, right? Because of the market condition, actually getting talent is arguably easier recently than it has been in the previous 3 to 4 years, especially talent here locally. But at the same time, it's never been harder. The venture climate is far more constricted. The fundraising targets are a moving goalpost. I can tell you this from experience that in the last couple of months, as we've talked to investors, we have not gotten any consensus around what the metrics are for fundraising, because I believe from my hypothesis, investors themselves aren't really sure what are the right metrics to invest in. So it's certainly become a lot harder at the same time as it's getting a lot easier. But luckily, there's still an abundant number of opportunities that are available. So that's always good to know. The feeling that I have been getting recently, given the fact that and I've only been through one major downturn. There's other folks who you'll talk to, or you may have the opportunity to talk to that have been through the .com bubble. But the feeling that I've been getting recently is that it feels like relearning to ride a bicycle. I'm sure everyone here can relate to that feeling where like you haven't done something in a long time, and you're getting back on a bicycle and you kind of have a sense of what you're doing, but it feels awkward, it feels new, it feels different, and it feels foreign. And that's what the conditions today feel like. Is the job of a CEO has always been very complex, but it's even more complex because you not only have to deal with imperfect information about your business, but you're dealing with imperfect information about the market and not knowing what valuations look like for fundraising and the like. So that's sort of the general feeling. I don't know if this resonates with anyone, but that's the feeling that I've been getting, especially recently. Being in the same direction with your team has become a matter of life or death. Before, it was important. Like having worked with a number of different companies, it was very apparent to see the companies that were messy and the companies that weren't messy. The companies that were messy, that strong team members, not everyone was aligned, but they had a great market opportunity, lots of venture dollars behind them, and they'll figure it out. In today's climate, there isn't lots of free capital or inexpensive capital. And as I'll talk about in a moment, but competition has become far more fierce. Your team is your primary asset. And having a team that is strong and operating in the same direction will carry you forward, right? I don't know how many folks here follow cycling, but when a team competes in the Tour, Tour de France, for example, or any tour, there are there's a team of 9, 10 people that are all supporting one person who is supposed to win the race. And it's a very similar mentality here. And obviously everyone is a very important part of the team, but as a CEO, you have to get everyone aligned to helping you accomplish your goal of fundraising, doing sales, and the like. So a very, very strong team in the same direction is very important. This is an analogy that I gathered from sales. In sales, when you have different salespeople within your sales organization that are selling functionally similar things, but it's not exactly the same, you end up selling very different products, and then end up wreaking havoc on your business model as a whole, which is a whole other topic. But any sort of any changes that your team makes to the primary goal of the company, or if they don't quite understand what are the priorities of the company, could mean life or death. And I'm speaking about this from experience. We made a couple of mistakes over the last 3 to 6 months that we learned the very hard way. One of my favorite quotes that has always been in the startup ecosystem that I think is far more relevant today, and I'll talk about it in a slightly different context, is everyone has a plan until they get punched in the mouth. There's a great, interesting quote from Mike Tyson that has been very prevalent in the startup ecosystem. But the reason I bring it up today is the speed at which you have to recover from being punched in the mouth or having a plan not work is absurdly fast. You have no leeway to like sit back and take a few days to reflect or take a few weeks to reflect because the market's moving so quickly. And again, because competition is so fierce, the speed at which you absorb changes that you're not ready for is very important. And this relates really to the previous slide of function with the team. Your team and you will end up having to deal with a lot of different changes. And the speed at which when you see a change, you can implement it into the company is paramount, which means being able to work really, really well with your team because your team isn't as privy to as much information as you. And when you make these changes to the organization, sometimes your team lags behind in their knowledge of the changes. And it's very important for you to have that like feedback loop and that cycle operating. You always needed an advantage in a startup, right? Like we always, and again, Graham and Walker and any venture fund when they're investing will ask like, what's your advantage? What's your advantage? What's your advantage? In today's climate, you need like a whole company advantage. You can't just say like, oh, we are first to market. You can't just say like, we're going to win because we have this IP. Like you have to be the best in every aspect of your business if you want to be the category leader or if you want to make it in this market. Because fundraising dollars are more scarce, your competition is, could very easily copy what you do. Again, speaking to the first slide, it's never been easier to start a company. It's also has never been easier to copy what, for your competitor to copy what you're doing. So you can't depend on a single competitive advantage. You have to understand how to be the best in every aspect of your market and also be very cognizant of the changes in the market to understand where are the opportunities for you to be a leader in or for you to grow in or for you to build a competitive advantage in. Because, as you know, and everyone knows, like it's a multifaceted problem to build a company. And you kind of have to be aware of all the different areas where you can have a competitive advantage. And you have to make your competitive advantages and moats known and robust. The market has to know what you're good at. Again, because of the nature of the startup world that we live in and the PR engine that drives sentiment and understanding of a market. And funny enough, like this one we learned not because we did it well, but because we didn't do it well. Was the market has to know about your competitive advantages. It has to know where you're the best at. So all these different things that I mentioned as being, building competitive advantages, you have to find a way for the rest of the market, whether it's your customers, whether it's your investors, your partners, and the like, how you make those moats known. Now, this might be antithetical to other advice that you're getting to kind of operate under the radar and be stealth. Again, like this is much like any advice up for interpretation and you apply to your individual use cases. But at least from what I've seen and from my perspective and my limited vantage point, the notion of building stealth startups under the radar has become far more difficult. Fundraising for stealth startups has become far more difficult. So you kind of have to be far more open and far more known as opposed to like flying under the radar, hoping that you can build enough momentum to raise funding. Competition lines are getting blurred as opportunities for mediocrity go up. Like we've learned this in our market, and I've seen this in a couple of other markets where businesses that were like sort of mediocre, like if they get large enough, they can eventually go through a liquidity event through an acquisition, are just not there anymore. What that means is if like everyone's constricted in terms of market opportunities, they're going to look for business and revenue wherever they can, because again, the investment market is far more conscious, and they're over, the investment ecosystem is over indexing for like revenue as a barometer for success of a business. There's a bunch of like very, startup term blog posts are being default alive or default to like all these different things. that all basically mean like revenue is important. And as revenue opportunities go away from mediocre products and mediocre companies, those companies and competitors will go after your business lines, and they'll go after your opportunities because it's seen as something potentially lucrative. So you have to be very mindful that your direct competitors will become far more fierce, and your indirect competitors may enter your space. So you should just always be ready for what competition looks like. And again, this goes back to the fact that you have to build a holistic moat around your business. You have to know your customer and your market. I used to use this slide as a joke of when, the Google glasses came out, 15 years ago, and nobody bought them. Nobody, no one. I'm sure Google spent a lot of money on customer validation, but not really. And I'm not saying you need to do customer validation, but you need to really know your customer and your market, because having product market fit is no longer a nice to have. It's really weird to say this, but for many years in the startup ecosystem, investors used to invest in like things that kind of felt like product market fit. Yeah, you got them, $1.5 million feels like product market fit, fine. Investors are no longer investing in things that feel like product market fit. It has to be product market fit, and you can't get the product market fit without knowing your customers and your market. So we at QVN are spending far more time understanding our customers and doing more robust work around understanding their pain points and how we can solve them than I think I would have done 3 to 4 years ago. So you have to know everything about your customer, and this is the same. This was always true, but it's even more important now. Who will buy it and why? How do they make their decision? I think that the middle bullet point is one that never gets enough credit. I think it's really easy to to talk to customers and to like see what their pain points are, and it's also really easy to understand who your customers are and why they will buy it. The place I see a lot of entrepreneurs really not invest enough time is the decision matrix that a customer will go through when deciding on what to buy and when to buy and when to make a purchase decision. Are they asking their friends? Are they going on blogs? Are they watching YouTube videos? Unless you know what is the motivating factor around your customers making a decision, the rest of the exercise is only going to get you so far. So it's even more so important now to understand what really motivates decisions, because the other thing that's happening in the current climate is acquiring customers has gotten very, very, very expensive. Why? Disposable income is not where it was. Everyone is using the same channels for acquiring customers. Your CAC costs are going to be astronomical if they're not already. So you really need to know more about your customers than anyone else, because you don't want to be, burning the little amount of venture funding that you have, or other revenue that you have, or other funding that you have, on tests that have no data points that have informed them. So understanding the decision is really, really important. Focus on getting enough money in the banks, whether it's, to get you cash flow positive, whether it's from customers or investors, especially during this climate. Understand whether or not it's a bridge round, an extension round, venture debt, or the like, if it's if you're going the investment route, or getting as many customer deals closed as possible, or getting contracts closed as possible. Just be hyper vigilant and focused on revenue. And try not to take too much advice, including and especially for me. The problem with the market that we're in, and it's making an assumption that we kind of know what market we're in. So we also don't know what's happening. There's so many like macroeconomic climate changes, and the war and Russia, Ukraine, and there's so much going on that you will see this vacuum for trying to make sense of it all. And whenever there's a vacuum for people, someone's going to fill the noise. So be cautious about taking advice from somebody, even if they've been through previous downturns, even if they tell you that they've built a successful company in the past and they know what they're talking about, and they've been through market conditions. There's this great quote or tweet, whichever one it was brilliant, said, if you take 100 quarters and flip them 100 times, there's always one that's going to flip heads 100 times. And then that one coin will tell you how smart it was and how much it made the right decisions and everything, but it was just luck, right? So be very cautious about who you're taking advice from, and don't take too much advice. Every market condition is new, and the one that we're in is no different. So always try to make your own decisions. start to be, even more comfortable with making decisions, not having all the information. But more so than anything, be careful about being as reactive to advice as you might have been in the past. The one strategy that we have employed at Culina as a result of the market conditions, and this comes as a direct result of it being a lot harder for people to understand what you're doing, especially since we're operating in a unique category. As Divya mentioned, we're building this, this notion of clinical nutrition. Not many people know what it means. It's a very busy space, so we've effectively had to define our own category. There's this great book called Play Bigger that helps you understand this. And the reason this is so important is, I'm going to go through this very, very briefly, but in the space that we're in, or in the market that we're in, defining the category that you're part of that you can win at, and the category has to be big enough. That's the that's the caveat. You can't own a category that's $1 million in size. It has to be still venture fund size. But defining your own category is going to make it easier for investors to understand what kind of business you're building, and it's going to help you and your team align towards the goal that you're building of being a category leader. Southwest Airlines is a really interesting case because they were the antithesis of airplane travel when they were formed. Only 15% of all travel was on airplanes in the 70s, and it was very expensive. So what Southwest Airlines did, what Southwest Airlines did was go after the 85% of people that haven't traveled yet. Right, so they defined a whole new category of travel for people that have never traveled before in their lives. Right, so when Divya said, Culina Health is supporting 300 million people in this country that are metabolic disorder, that's a number that wellness nutrition has never even touched yet, because wellness nutrition doesn't go after patients that have some sort of chronic condition. If you think about wellness nutrition, you think about weight loss. So we at Culina have had to pivot and define our own category, similar to the way that Southwest Airlines has done, because it's the only way for us to compete in the market that we're in, and given the current opportunity, right? So, and what it does is it makes it harder for other companies to copy you, because you're creating a whole new unique approach to a whole unique category. And then when investors look at companies that are similar, but one is effectively creating a category, another company is like, oh, this is a great opportunity, let me copy them. It's not comparable. It's a lot more difficult for a competitor to say, we're going to do the same thing as Culina, because we're trying to build this category. We're becoming synonymous with the category itself. So Southwest Airlines went after the 85%. Funny enough, I'm going to skip through this because you don't need to go through this, but funny enough, Lyft did the same exact thing. I used to use this as an example in my class around 6 or 7 years ago, when Uber and Lyft were in brutal competition with each other. Lyft at one point rebranded and said Lyft, alternative to bus and train. And it caught everyone off guard. And arguably one of the reasons that Lyft is successful today, not hyper successful, but alive, let's say. One of the reasons that Lyft is alive today, even though Uber is the clear dominant leader, is Lyft went after the people that were in a very different category. They went after people who were not necessarily thinking of taking an Uber, and made it effectively in the minds of the market, the price conscious competitor. And that's effectively what I think you should try to do if you're building a company in this market. Is you have to define the category that you're playing in. You have to know more about that category than anyone else, and you have to move fast to own it. Again, because competition is so fierce and the market conditions are changing, speed is definitely important in the current conditions. But let me pause there. I've already talked probably longer than I should have, Divya wanted me to, but let me pause there. If anyone has any questions, I will do my best to answer them to the best of my ability.
Steve, I have something that was DM'd to me, so I'm going to ask that question. You talked a little bit about talk to your customers. So I think it's sort of related to that. How would you suggest is the best way to test your idea? In your super early stage, you have an idea, you believe it has legs, or what is that early testing? What does that look like? And do you have a framework?
Yeah. One of my favorites is a combination of Google Trends and Google AdWords. So look at Google Trend data around the particular topic, and then take out some Google AdWords and see how fast the spend goes. And that's not really huge. You can do like $25, $50, but it shows intent through the Google Trends, and then that people are willing to take action through the Google AdWords. That has been my favorite and one that I've
That is brilliant.
That would be the one that I would use.
I love that hack. That is so smart. I see.
It wasn't my idea. It wasn't my idea. So I'm not taking credit for it. I'm just passing on information that I heard somebody like. It was another founder who said the Google Trends, and then I added Google AdWords. So like I think the combination, to your point, is very powerful.
Yeah, I can totally see. Yeah, no, I think that's really smart, and also, I think this is how we learn the best hacks, right? We try them, hear them, make a note of them, share them. So thank you for passing that along. There's a question here by Marissa. Marissa.
Yeah, stealth mode. So yeah, it's a great question. I see it. I mean, it's more difficult from a position of fundraising to be in stealth mode. It doesn't have anything to do about telling people before it's ready. It's from the experience that I've seen, it's more difficult to build like a startup under the radar without being public around your intentions, or that public around the problem that you want to solve and the like. And again, it could work strategically for you if you decide that building a stealth company. I used to joke around with my wife many years ago, and Ali might remember this. Ali was part of the NYU system. He's still on board, but my wife used to go to events, and she was not a startup founder. And whenever anyone asked her what she did, I always told her, say you're building a social media startup and that's in stealth mode. And no one asked questions. It was like the thing to do. And it's become far more difficult to build a company under the radar than I think it has been in the past. Again, from my experience, you should still validate your idea with other people. And if you want to build like an MVP before going out and fundraising without telling anyone else, fine. But that feedback was more specifically that it's much harder to sort of build a company with the premise that at some point you'll release this and it's going to be this great big company and it's going to be amazing, and you just need 2 years to build it and $10 million. Like those sorts of pitches are not gaining as much traction as they would even 12 months ago.
Another question I have here. Oh wait, sorry, Marissa has a follow-on. She's saying, trying to understand what if you meant don't hustle in silence. I think so, right? That's kind of what you're trying to get at, which is if you're building a company, actually it really helps to ask as many people, talk about it enough time so that you're constantly sort of getting, it's not in your head and you're not like sort of working on it alone. So I think yes.
Yeah, Marina, to your question, I don't, follow question here, is there an interim stage between stealth mode and fully public release? Can we have a website? Yeah, I don't know, maybe Marina, do you maybe want to share the context? It might be helpful.
Yeah, sure. We are thinking that, we may be able to test our messaging to get some traction without telling the full story, so our competitors jump onto the ideas, because we are pretty sure that there is a product market fit there, and we don't want to give extra information to anyone. At the same time, we do want to, we have an MVP that is working, and we do want to start attracting more customers rather than our network that is easy. So what would be the approach there? Do we have to be either out of sales or in sales? Can we be somewhere in between?
Yeah, totally. I think you absolutely can. You shouldn't think about it as in stealth or out of stealth. It's just don't build a company. Don't build a company, as Divya I think mentioned, completely without input from others, especially customers, to show you where traction is. Like I mean, that's always been difficult. Only a few people have been able to successfully deploy like stealth strategy to like massive market opportunity. Yeah, I think what you said is right. You don't want to release too much information, but you also don't want to stay completely under the radar.
I'll also just add there, like, I feel like a lot of founders, and this may not be, fully, take this with a pinch of salt, you know your company best and what you're building best. But I will say that a lot of founders are worried about, giving out too much information too early. And I will say that from the investor point of view, and as being an operator in the past, really it's your execution. At the idea stage, I know it feels like you're very close to your idea. You feel like, okay, this can be taken, but really, like, that is a fear. I would really encourage founders to sort of like throw out the window, like just execute, put it out there. You are more likely to do better by putting something out, even if it's not perfect, and keep chiseling to make it better with the input that you can get, because more likely than not, the first thought is coming out of fear, and what you want to do as a founder is not operate from there. Operate from strength. Go build. I have another question here that is around traction. Steve, can you talk to us a little bit about examples of early traction? Like, what would you define as traction? What can founders sort of count on in their story of, what are like worthy metrics to be counting as traction?
Well, if it's okay, I'll split this up into the two separate parts. One is the qualitative, one is the quantitative, like the actual number. From a qualitative perspective, just don't make shit up. Like that, like there's always the urge, and we faced it, where you had a couple conversations with a potential partner or a customer, and you're like, yeah, they're a client, and they're not. So just never make up a statistic. If you feel like you have to make, like, as founders, we always have to bend the truth. It's part of the game. Like, you have to create an alternate reality where, the opportunity that you are pursuing is the biggest, the thing that you're doing is the best, and your team is like, King Arthur and the round, the Knights of the Round Table, saying like, number one, and not number two to anybody else. Like, that's just the nature of the game, except when it comes to traction. When it comes to traction, like, you have to be very realistic, because in most cases, before February, March of this year, investors were calling customers. In every case, investors are calling customers today. So that's point one, is be very diligent about, bending reality in every aspect except for traction. In terms of like what we're seeing as traction, it's the goalposts are always moving. I'll say this with the caveat that Culina is a unique case. We raised our seed fund for our seed round with more than $1 million in recurring revenue, which is not typical. Like, most companies, raise a seed fund and then make it to like 1 to 2 million in ARR, which in the market that we raised funding made it a bit more complex to raise funding. So that's something that's important to keep in mind. So like, my vantage point isn't necessarily like what's happening with seed raises now, but I can tell you that whatever you hear as whatever you hear is like the metrics that you should reach, assume that they're underestimates. So for Series A, it used to be 2 million in ARR, and we surpassed 2 million in ARR. And I can tell you that raising Series A with 2 million in ARR is very difficult, if not impossible. And like 12 months ago, we would have been getting term sheets left and right, that's presumably, because 2 million was like considered excellent for a Series A company. So the best advice that I can give, or the only response I can give to that, Divya, is like, just assume whatever the market conditions dictate are underestimates. In terms of like other points, like from a B2B perspective or enterprise sales perspective, having just signed contracts is not enough. I mean, I'll give it to you a use case for Culina. We sell to enterprises, and having actual patients coming in through those channels is a better barometer for success than saying we signed this contract and it could be worth $10 million in 10 years. Like, that's amorphous. Having actual revenue churning through this cycle is more important. So same thing with, if it's a SaaS business, if you sign a contract, great. Like, what's the revenue that it's brought in? Because just because you sign a contract doesn't mean it's launched, doesn't mean you've implemented, doesn't mean you have the capacity to absorb that, the person as a client. So I'd say like actual traction is perhaps the most important barometer of success, not like signed stuff.
Thank you. Question here from...
And sorry, and sorry, last thing, momentum. So like month-over-month growth, also very important. Sorry, go ahead.
Yes, definitely. I am looking at another question here from Anna Maria. What are the fundraising
seed and pre-seed?
Mm-hmm.
Yeah, sorry. So seed and pre-seed valuations. Very roughly. So take this with like not a ton of data points, only because I'm still getting a lot of investment deal flow from this angel syndicate that I work with and fund that I'm a part of. So maybe Divya might have more context than I do, but pre-seed, probably like 3 to 5 million, 6 million cap, seed 7 to 10 mil cap for notes, maybe around there. I wouldn't say much more than maybe a little bit, a little bit higher, maybe the 12 mil cap if you have revenue. Very few investors. I mean, there's investors who will only do priced rounds, who won't do like notes or safes. I'm seeing far more adoption of safes only because now it's hard to price companies these days, and no one really has a good barometer to like how to price companies. So I'm seeing far more convertible notes and safe than priced rounds in terms of like a percentage. Yeah.
Yeah, there's another question actually that was sent earlier during registration, which is convertible debt, safe agreements, or equity, or does it matter? How would you address that at this stage?
I mean, multifaceted. I always say that my recommendation would be to, at this point, do convertible or safes because it's harder to get investors to subscribe to a price. Again, there are investors who will never do a note, will never do a safe. And so be mindful of that. You might have to price yourself with certain investors, but at least the ones that we've worked with and the ones that I've worked with have not. And yeah, I guess the follow-up question to that, without discounts. Yeah, without discounts. I mean, safes are just so much easier these days. There are convertible notes. We haven't done any. We've just done everything through safes at Culina. It's very, very common now. I see very little pushback on it. It just makes negotiating things easier. If you have to do, those are caps with some with discounts, some without, but definitely, notes are not as common as safes because the interest rate is less of a consideration factor, and the maturity date is especially less of a consideration factor because most investors don't know what maturity dates will look like. But again, I have a very small vantage point.
This is an interesting question. And I think, I definitely, on the investor side of it, have met a lot of founders who have had to sometimes give this feedback. So someone's asking, how do I know if my business is right for VC? I get feedback all the time that this is not VC ready and may be better off as a lifestyle business.
Totally. I have two. I'll give you the metrics that I used to talk about. Let me just pull them up. I actually have them right here. So for something to give venture scale returns to angels. So everyone understand or anyone not understand the step function of fundraising. There's angel, pre-seed, seed, series A, B, C, D, right? So assuming everyone is familiar with that, if not, there's Google fundraising rounds. The big shift happens between pre-seed and somewhere between seed, where investors go from investing their own money to investing somebody else's money, which fundamentally changes the dynamic of expectations for returns. If you're raising angel funding or pre-seed funding, the expectation is for an exit, and that exit can be $10 to $50 million, right? Because you raise not a lot of money. Once you cross that threshold into seed, the minimum expectation is $100 million, $250 million, right? Why is every fund anticipates a minimum 10x return, has to anticipate a minimum 10x return for this to be a venture fundable deal? Because the context behind it, if you have there's a great book called Venture Deals with Brad Feld that'll, I think there was another question around books that we can recommend. That's a good one. Is venture funds have to return their money back to investors, and the only way they can return money back to the investors is if they have a couple of like rock star companies. You don't get away with returning a venture fund by having a couple of 1x mediocre return companies. You need big exits. You need like an Airbnb. You need an Uber. You need a Snowflake. You need Data Robot, because you need to be swinging for those kinds of deals for them to return effectively your whole fund, which is the strategy. And if you take that into consideration, then the company has to have inherently a market that is worth billions of dollars and an exit potential that's worth hundreds of millions of dollars, because otherwise the economics just don't work in that way. So once you cross that threshold of raising money from people who are investing their own money to those that are investing somebody else's money, you have to be very mindful that you have to be able to return $100+ million in an exit event. Now, it doesn't mean your company's not venture ready or venture fundable. That just means you're not ready to take money from institutional investors. There is plenty of capital from individual investors, so like you should make that distinction, but just be cautious about understanding where the source of capital is coming from.
There's another question around, okay, and this is actually very interesting. What is an example of a startup that you watched build for resilience in a financial downturn? What about their strategy stood out to you that could be repeated?
I don't know if I would call it an example. There's been several through the Future Labs that have been great. What I will say is the ones that have had successful exits that have also been through this financial or through some sort of a downturn have made big pivots. Yeah.
So I think
sorry.
It's like listening to your customer again, right? Like, again, a pivot is about recognizing whether your company is relevant to the moment. And if that's changing and you're hearing something different from your customer, how quickly are you able to make that decision, listen to that signal and shift strategy?
Totally. Everyone, it's interesting because it's a bit antithetical to the typical startup advice, which is you as a founder know the market. You as a founder believe in, the things that you need to believe in, while everyone else doesn't believe you. And that's all true. But you also have to have loosely held convictions, right? Like one of the best terms is always have strong convictions loosely held, because you never know what you don't know, right? There's this notion of unknown unknowns. Like you don't know what you don't know about the market. And even if you're like an expert in the market that you're in, there's things that you're going to learn in the process of execution, to Divya's point, like why it's important to get a product out to market as quickly as possible. That being said, like making these pivots is a function of learning the market, seeing where the opportunity is. Your goal as a founder is to continue to succeed over the course of the startup, right? Like you have changing conditions that you have to absorb. And that's the reality of it, right? Like and even your job, your function as a founder and CEO of a company, for the CEO of the company might be over a short period of time, right? Like it could get you through Series B, and maybe your investors think that it's best to switch to that, which is a whole other conversation, not for this topic. But the way you stay relevant to the company and the way you make your company stay relevant is you identify where the opportunities are, you see whether or not it's relevant for your business to be a part of that opportunity, and then you take it if you, again, your goal is to know about the market, know more about the market than anyone else, right? That is more of a competitive advantage than you might realize now. Like a lot of, this is why I said, like, understand your whole company advantage. Most founders, when they hear the word competitive advantage, it's what am I building that's unique? It's what IP do I have that's unique? What channels do I? Sometimes it's just knowing more about the market than anybody else, right? Like we have a superpower at Culina, and that's Vanessa knows everything. My co-founder Vanessa knows everything about the dietetic space. There are lawyers that we talk to who get paid thousands of dollars an hour to advise other dietitians that know less than Vanessa about how to bill for dietetics. That is a superpower that you cannot replace. And I've come to believe that knowing your market better than anyone else is as much, if not a bigger competitive advantage than anything that you can build internally, because you can always pivot. You're like, oh, like this is a market opportunity that we hadn't realized before because we know this about the market, right? So knowing more about the market than anyone else is a superpower.
100% agreed. There's two questions I have here that were sent during the registration, and I want to be able to get to both of them. One is around the attempts at cash conservation. When you're bootstrapped, and especially if you are in this particular market, you want to make sure you're spending wisely. What kind of attempts at cash conservation do you think can do more harm than good? Yeah, how would you?
Great question.
Yeah.
Anything that costs you revenue. We've struggled with this ourselves. Everyone says conserve cash, but at what cost and at what opportunity cost? So my limited feedback on that, given the position that we've been in, is look at it from the perspective of opportunity cost. If conserving cash is an opportunity cost, then I would advise against it. Again, every case is unique and you have to consider what your situation is, but you should never do it at an opportunity cost. An opportunity cost could be revenue. Opportunity cost can be, building a market position. It could be, any number of things, but always look at it from an opportunity cost. And it shouldn't, obviously it shouldn't cost you revenue. In our case, I can tell you that we did do something that was even antithetical to that advice, is we looked at a channel that was working in terms of generating new patients, but it looked from our data points that it was trending upwards into an area that was becoming uncomfortably expensive. So we took the action to cut it off before it even reached that level. That's because we took into account certain data points. We could have been wrong, but we saw the opportunity cost for waiting being too great. That is definitely, I'd say, the primary one is like the cost of revenue, opportunity cost.
And then this one's interesting because I think a lot of founders struggle through this. It's around raising friends and family account, raise, right, as a first raise. How do you sort of ask friends and family for that first raise? It's a tough ask for a first founder if you've never done this before. And what terms usually do you do that with?
Yeah, it depends on the round that you're raising. If you're doing like a true friends and family round, that is not going to include any venture investors, which would probably be my advice, is raise friends and family in coordination with some but some outside money, whether it's like an angel fund or an angel group and the like. It'll make your life a lot easier because your friends and family, unless they have a background in venture, will have no clue what caps are. And it gives you the latitude to like say, well, I'm a 50 million cap company, like with my one other employee, right? And I've seen companies that have raised friends and family funding at like absurd caps and valuations because friends and family don't know any better, and the founders think that's the right thing to do, right? Like I'll dilute myself a lot less if I raise it at $50 million cap. Very complex. Always try to do it alongside an angel group or the like, or get advice from an angel investor or an angel group on what terms you should close the money. If all else fails, raise it at pre-seed levels of 3 to 5 million cap, which is pretty fair. But I would not do that without getting some advice from investors, because you don't want to, one of the best advice, I actually heard this from one of our lawyers, is, when investors invest, they look at, think of it as like a tree that's standing, and anytime there's something that's different about your business or off or is against the pattern that they're used to, it's like, chopping away at the base of the tree. And if you chop enough times, the tree falls, and they're not going to invest. So if you don't have a product and you haven't really generated revenue, and on top of that, you raise a friend and family round of like a $50 million cap, like that'll just be another thing for them not to invest in. So always try to find what market terms are, through different angel groups and the like, if you are raising money from friends and family.
Sorry, I was on. Yeah. Last question. If anyone has any other questions, like drop it in the chat now. Otherwise, I want to ask a question that was asked in the chat before, as sort of like our bookending our conversation. What are books that you recommend for early stage founders? You mentioned Brad Fell's Venturefield. I think that's a great recommendation. But are there others that you think, from a leadership point of view, from like understanding terms, if you're trying to raise, what recommendations do you have, Steve?
Play Bigger is a good one. That's my recent one that I've read. It's Play Bigger: How Pirates, Dreamers, and Innovators Create and Dominate Markets. There's a good book that was recommended to me, especially if you're a CEO of a company, called CEO Excellence. And it's about what your job is as a CEO. I think it's a very good book. What else would I recommend? Leadership books.
I like 0 to 1.
0 to 1's a good one. I like 0 to 1. Obviously, Eric Ries's books are all very good, especially if you're completely new to the area of startups. Like Eric Ries's book, I don't know why I can't remember the name. Lean Startup is a good one. Or his new book, Startup Way. The Startup Way is more towards larger companies, but at least, through that topic, you can understand it. I'd say those are, and then there's almost, I don't know why I like this book. I think I like this book only because of its title and how I feel as a founder, but the former Intel CEO's book on Only the Paranoid Survive.
Only the, again?
Only the Paranoid Survive.
Only the Paranoid Survive.
Which actually might be a very, very timely book for where we are, because the subheader to the book is how to exploit the crisis points that challenge every company. But that's for a follow-up. But yeah, that's also a really interesting book. Again, not I wouldn't recommend it as like a top 15 book, but that one I think is a good book just to have. Yeah, I'd say I can come up with a few others. I don't have the top of my mind yet, but I can send you a handful of others.
Yeah, we can add that to our follow-up. I think it's always fun as an entrepreneur, and to have this running this. So yeah, we'd love your recommendations. Tiffany has a point.
What else is read them before you start your company. The amount of time you have to read goes down drastically.
This is true.
Oh, Hard Thing About Hard Things is great.
Yes. Tiffany is just asking last question because we have 5 more minutes.
Sure.
Would you say that in this current climate, one would have to bootstrap further prior to raising outside investment compared to the last few years? Is that a good strategy?
That's a great question. I'm not going to give you, I think, the answer that you might be looking for. Yes and no is the answer. From our experience at Culina, having had bootstrapped as long as we did made it harder for us to fundraise. But we also raised December of last year, December, January. So it was just before the most recent sort of market conditions. So I don't know if it's a great barometer to how investors invest now. I would probably lean towards no, because if you bootstrap to the point where you have conviction, then it doesn't matter, right? Investors are still investing in great business opportunities that have signs of success. So definitely, like I'd say, don't do it longer than you have to. You're not going to get significant. Like one of the reasons that we did it, which semi-worked, kind of worked, but not really, is it allowed us to get a slightly higher cap than typical seed companies in our stage. But it made it much more difficult to fund. So it was like catch-22. I'd say, especially in today's climate, you're either going to get a term sheet or you're not. And how much further along you bootstrapped is not going to help your case. If you've bootstrapped, that's checkbox, right? Like bootstrapping longer than you have to is not going to be seen as something positive. And I'll answer Marina's question, then I will jump off about advisory board. Only put people that you want to have on your deck. And if you have advisors, make sure you use them. Even we have advisors that we've paid with equity for that we're not using. And sometimes you were like, oh my God, we want advisors because it's the right thing to do. Only bring on advisors if you need them. And if they're going to be somebody who you'd want to put on your deck. If it's there to just, like, just because you feel like you need an advisory board, that's a bad idea. Don't just do it just to do it.
Is it only for the deck?
No, but they should be like, that's the mentality. Right. You can use advisors for yourself, but they shouldn't be they should not be compensated advisors that you bill on an advisory board. If you want to have if you want to have advisors, just have advisors, and they should not be compensated. And the best people, like other CEOs and other co-founders and other people in the network. Like if that's the kind of advice you're seeking, do that. Don't give somebody equity as an advisor because it changes the dynamic. If someone is like good enough to be an advisory compensated, or sorry, somebody who's like an advisor that you would compensate, first ask them to invest.
Okay, thanks.
They aren't willing to invest in a single founder team. Sorry, this is to get feedback from investors that they aren't willing to invest in a single founder team, and other advising not to bring on a co-founder if we didn't need it. That's just noise. That's not a signal, that's a noise, Rachel. Everyone, I think it goes back to the quarter example that I shared. Some people just have a worldview that they know the right way to invest in companies, and that's the only way that they're investing in companies, and there's nothing that you can do or say to change their mind, and it doesn't mean it's the right advice. Do what you feel is right for the company, and then find the investors that align with you. We, between Vanessa and I, we passed on investors that didn't believe in the way, like we're co-CEOs, as you heard Divya say. That did not fit a lot of investors' investment mold. Doesn't matter how good we were as co-founders. Doesn't matter how much experience that she and I had, and how much an advantage that we had by meeting startup ecosystem for 12 years and having seen dozens of companies fail and hundreds of companies succeed, and her being a dietitian for 12 years that helped a nutrition company exit. They didn't care. Co-CEOs just didn't fit their model. So there was nothing that we could have said to convince them to invest in us. And it took us a long time to figure that out. So everyone just has advice. So don't always take it. Okay, I need to run.
Yes, I know you have to go, so I'm gonna let you go. Thank you so much, Steve, for this incredible discussion, and thank you everyone for joining us. We will be sending a recap email with the recording of this presentation, and also be sure to be opening our community emails that we send out once a month, so you are up to date with the upcoming events. Thank you so much.
And email me if you have other questions. Steve@culinahealth.com.
Awesome. Thank you so much, Steve. This is fantastic. Thank you. Have a great rest of your day. Bye-bye.